Hi there, welcome to Kneppy Invest. In today's video, I'm going to discuss the disaster story that is Dubber. Share price today on October 10 has fallen at 25%. But not only that, the share price of this company has dropped by more than 90% since September last year. In fact, the market cap of this company has dropped from 1.1 billion down to just over 100 million. And not only has the valuation of this company dropped significantly, in financial year 21, this company lost $80 million and is still burning through a lot of cash. So I'm going to talk about the disaster story that is Dubber. Dubber is a provider of cloud-based call recording and voice AI. They call themselves the world's #1 unified call recording and voice intelligence solution company. Dubber was founded in 2011, listed on the ASX in March 2015. It was a backdoor listing, which was all the rage back then via Crucible Gold. The current CEO and co-founder is Stephen McGovern. He owns 3.2%. And it's interesting that BlackRock owns 4.2% of the company. Now, in September 2021, the value of this company, or the markup of Dubber, was $1.1 billion. That was at a share price of $4.33. Now, October 10, 2022, the share price is just above 40 cents. I think it closed at 41.5 cents. And that means the markup of this company is $122 million. So this company's valuation has dropped by more than 90%. Not only that, since this company did list on the ASX, shares on issue have about quadrupled, increasing from 78 million to 305 million. And the reason why shares on issue have increased, because this company burns through so much cash, they have to do a lot of capital raisings. Hopefully, and I haven't looked into this, hopefully they did a capital raising in September last year to take advantage of that really high valuation. And hopefully they don't do a capital raising soon, because that would be the worst timing and really bad capital allocation or capital management. And the T code of this company is DUB. Now, the first reason why Dubber has been a disastrous story is because of this particular chart. This is the daily chart going back to February 2020. And during the COVID-19 financial panic, share price of this company dropped below 50 cents for 2 days and then recovered quite quickly. In fact, the share price recovered from, we'll say, about 40 cents to around about $1.40 in about 2 to 3 months of trading, and then kept on increasing, reaching a high, I think it was $4.33 in September of last year. And then you just see the share price turning around, sentiment change, share price moved into a well-defined downtrend during this, probably the end of 2021, start of 2022, definitely by the end of January or the end of December. By looking at this, the share price was in a well-defined downtrend, and that really coincides with the tech sell-off we have been seeing, particularly on the NASDAQ and also here. So Dubber was unfortunately a victim of the circumstances of this tech sell-off, of the very fact that interest rates were rising. And the market didn't want to see these type of companies, or didn't want to own these type of companies, because the future profits or possible profits this company had was well into the future. And the way you value a company is you take the present value of all future cash flows, and if interest rates going up, the value of all those future cash flows is significantly lower in a high interest rate environment. And that's why there was a significant sell-off in these type of companies, these unprofitable tech companies. And that's why the share price of this company has fallen about 90% and just keeps on falling. And then on the 10th of October, the share price fell another 25%. Now, to be honest with you, I had no idea this company released any negative news that could lead to share price dropping 25%, because I'm not following this company anymore. So we'll get into why the share price has dropped 25% on the 10th of October. And it's actually really interesting what has happened with this company over the past week, we'll say week and a half. Before we talk about why the share price has dropped 25%, let's just go back in time. In fact, quite a few slides following this slide, we are looking in the past, because to understand what has happened today, you need sort of a broader picture of what's happening with this company. And on the 30th of August, the company did release their Appendix 4C, which is a preliminary final report to the Australian Securities Exchange. So these are the financial statements that the company itself has provided to the market. And this company is growing based off the revenue. So service income grew from 20.3 million to 35.7 million. So pretty good growth in revenue. So this company has been growing really strongly in the past, the top line, and that's why the market was really interested in Dubber. That's why the market pushed the share price up to $4.33 and the valuation beyond $1 billion, because at that point in time, the market only cared about revenue growth. They didn't care if a company was not profitable. That does not matter. Who cares if a company is not profitable? It's all about revenue growth. And for the year ended 2022, this company was loss-making to the tune of about 64.7 million. Last year, they were loss-making to the tune of 31.7 million. So they've actually increased their losses in the past year. So even though this company was bringing in almost double the service income, they were burning through a mountain of cash. So this was one of the reasons why the market did not like this company and why the share price was being punished. But there's more to tell in the Dubber story. And this little note in the Appendix 4E is very important for future reference. So the Appendix 4E preliminary, and that's a very important word too, final report has been prepared in accordance with ASX Listing Rule 4.3A, and the financial report is in the process of being audited. So this Appendix 4E has not been audited. We have to wait to the annual report to get those audited numbers. And most of the times, you don't see any or much difference between the Appendix 4E or preliminary final report and the audited report that you do find in the annual report. And the annual report was supposed to be released by the end of September or the first day of trading in October. And if a company doesn't release a document, a financial report, by the time they have to release it, they will be suspended from trading. And that's exactly what happened to Dubber on October the 3rd. There were a group of companies suspended from trading on the 3rd of October because they did not release a relevant periodic report by the due date. So the ASX is quite hard on this. You have to release a relevant periodic report by the time it's due. If you're not, your shares won't be able to be traded by shareholders, and shareholders don't like that at all. And Dubber was one of those companies. So one of about 15 companies here, 12 to 13 companies here, including a company actually I do own, small holding in Vection Technologies, VR1, but then they released their annual report soon after this. So the question is, why did Dubber not release their annual report when it was due? And then on Friday, the 7th of October at 7:53 p.m., Dubber released their annual report. In fact, I'd probably say they couldn't have released this report any later than they could. And this is actually a bad sign. So I actually didn't have to look at their annual report. And they also released another announcement. And I did look at that other announcement today on the 10th of October, trying to understand why the share price dropped by 25%. But whenever a company releases a report like this, where shareholders and the market is waiting for it, and they leave it to the last second, or maybe not the last second, but they leave it to 7:53 p.m. on the Friday, the last trading day of the week, it's not a good look. And more than likely, there are some skeletons they are trying to hide. Well, maybe not trying to hide in the closet, but they've hidden some skeletons in the closet. And it wasn't in the annual report that we got clarification. It was in another announcement they made on the 7th of October at around 7:53. So let's have a look at that other announcement to get some clarification. So it was in this other announcement they made, which was marked price sensitive. So the annual report was not price sensitive. It was this particular announcement made 1 minute before the annual report. And this particular announcement was titled Notification Under Listing Rule 4.3D. So just the title of this announcement is not that exciting. Now, I'd say most people would be gravitating towards the annual report, but you do get a lot of clarification of what has happened why Dubber shares were in a suspended state in this particular announcement. And it's called the reconciliation of audited financial statements to unaudited preliminary final report. There is a discrepancy between what the company reported in their unaudited final report and to what the auditors wanted to provide to the market. And that discrepancy is in two areas. Service income. So in the audit report, service income is $10.3 million less than the Appendix 4A. And in general and administration costs, that is $8.2 million higher than in the Appendix 4A. And the losses for the company had increased by almost $20 million, in fact, $18.5 million. So this is the reason why the company was suspended for training, because the auditors found something they didn't like in the preliminary final report. And these are the explanations given why there was such a significant discrepancy. And this is one of the reasons why the share price has dropped 25%. Now, in my opinion, the market is probably overreacting, because I don't think this is relevant, as relevant as what the market is thinking. That's just my opinion. But anyway, revenue, why was revenue $10 million less? Because service income has been adjusted in accordance with AASB 15, revenue from contracts with customers, to reflect a modification in the treatment of platform and foundation-based income following consultation with the company's auditor. A review of customer payment history and timing of recognition of invoices issued in financial year 22 has led to an adjustment of revenue as stated in Appendix 4E. So a lot of gobbledygook for me in that reasoning. And this is one of the reasons why I tend to focus on cash receipts, not the profit and loss statement, is because in the profit and loss statement, you could get two totally different numbers from two totally different accountants or auditors. And I'll touch upon that in future slides. And then in the administration and general administration costs, why was $8.2 million more? Well, it has been adjusted in accordance with AASB 9, financial instruments for a single debtor. In that amount has been done due to failure of this customer to make contractual payments. The company deciding to provide for the full amount. The company notes that its relationship with this partner is sound and expects there will be revenues from this relationship in future periods. So there's a debtor that hasn't paid what they owe by 8.2. That's a lot. $8.2 million they haven't paid yet. And that is a significant red flag, in my opinion, even though they say, Dubber says, their relationship with this particular client is sound and they expect those revenues will flow through eventually. I'm not so sure about that, because if this particular client hasn't paid their money yet and they're supposed to have paid their money, that is a particular significant red flag. Now, this particular statement in this announcement is really important, and why I really focus on cash flow statements first and then move to profit and loss. So all the changes are non-cash and relate to the accounting treatment of revenue recognition. So that's a very important little bit. Accounting treatment of revenue recognition. So a lot of these accounting treatments of revenue recognition can be subjective. They could change from accountant to accountant or auditor to auditor. And actual cash receipts for financial year 22 are unaffected. So if you look at the Appendix 4E cash receipts or cash flow statement to the audited cash flow statement, there is no changes. The cash receipts of $29.9 million are identical in both, and the cash flow outflow is identical in both. And this is one of the reasons I like to focus on cash flow. It's because it's a truer state of the performance of the company than profit and loss, because profit and loss can be manipulated. And when I say manipulated, legally manipulated to make the company seem like it's performing better or worse than the market might want. And so that's really important moving forward, and why I tend to focus on the cash flow statement first. Look at that first and then work my way back. And this is a perfect example of why I do that. The board also mentioned that these changes do not materially affect the future final performance or financial position of the company. I actually tend to agree with that. These little squabbles between the CFO of Dubber, the once CFO of Dubber, I haven't mentioned this, the CFO of Dubber has resigned more than likely because of this. But I don't think this really affects the performance of Dubber moving forward. This is not what I'm concerned about this company moving forward. This is not really why I think this is disastrous for Dubber. It's actually the annual report, the financial statements, the profit and loss statement, the cash flow statement are the reasons why I think right now is disastrous for Dubber, why the share price has dropped 90%. It's not actually this single report. I think this doesn't really change how the company is performing. So let's go into the reasons why I think what's happening with Dubber right now is disastrous. And it's disastrous day, disastrous week, disastrous month, disastrous year. And the first place I'm going to start out is the statement of cash flows. I always begin with the cash flows. And don't forget, the annual report statement of cash flows is identical to, or probably almost identical to, the Appendix 4E cash flow statement. So we start with receipts. Receipts have grown from 20.3 million to almost 30 million. So we're saying a 50% increase in receipts. Unfortunately, the operating cash flow has significantly worsened from last year. Last year, the operating cash flow negative by 17.4 million. Now they're operating cash flow negative by 42.2 million. Not only that, they paid for an acquisition, 6.9 million, purchase of plant and equipment, 3.1 million, investment of cash at core deposit, 30 million. They also did a capital raising and received $110 million through that capital raising. But still, the cash on hand didn't fall. It rose from 32 million to 54.4 million. That's with the issue of $110 million worth of shares. So this company is burning through a lot of cash. And this is the main reason why the share price of this company has been absolutely punished. The board, the management of this company don't care at this point, or they don't seem to care at this point in time, that this company is burning through a mountain of cash. And it gets even worse. So let's have a look at the profit and loss statement and why I think it gets even worse for this company. After I look at the cash flow statement, I work my way back, look at the balance sheet, then go to the profit and loss, and then I look at notes. And this is the profit and loss statement. And there's a few things here that I just went, wow, I can't believe this company has not done any sort of review of the way they do business. Simply because if you look at the expenses have absolutely blown up in the past year. So even though cash receipts increased by 50%, service income has increased by 25%. And I think service income or revenue of this company will increase. It has to increase. It better increase because salaries and related expenses have increased from 22 million to 36.5 million. So just in salaries and related expenses, the cost of that is significantly more than the revenue generated in this business. Employees' share-based payments increased from 13.8 to 20 million. Direct costs increased from 10.3 million to 23.5 million. General and administration costs increased from 4.3 million to 20.4 million, and depreciation and amortization increased from 3 to 7.3 million. So this is the reason why this company was loss-making to the tune of $84 million compared to last year, only $32 million, because this company is spending so much more money. And the company needs to show they have some scale. And in the past year, the company has shown they have no scale at all. They need to show scale at this point in time. And the very fact that costs are increasing at a significant greater rate than the revenue is a bad sign for this company moving forward in these times. And let's just go to the general administration costs just to see why did the general administration costs increase from 4.3 million to 20.4 million? That's a significantly increase in administration costs. Now, if we take away the doubtful debts, which was 8.2 million, we still get administration costs increasing from 4 million to over 12 million. So that's, say, a triple increase in administration costs in the last year. So let's have a look. Advertising, marketing, and events increased from 863,000 to 3.5 million. Legal fees increased, or almost doubled, from 870,000 to 1.5 million. Rent increased, securities change and registry fees increased, corporate affairs increased, insurances increased, subscriptions and memberships increased from 350,000 to 890,000. Other administrations more than doubled. Travel costs, this is the one I want to focus on. Travel costs increased from 259,000 to 2.1 million. Travel costs of 2.1. What are they buying? What are they flying first class everywhere? Is the whole company flying first class multiple times every single day? How do you have travel costs of 2.1 million? How does the management of this company not realize the amount of cash this company is burning through? And with the share price falling like it is, they won't be able to go to the markets and raise more capital. Or if they do, they are going to seriously dilute their shareholders moving forward. And this is why this has been a disastrous day, disastrous week, disastrous month, disastrous year for this company, because management have no perception or conception of how to control the cost base. That's all I have on this disaster story. That is Daba. Share price dropping by more than 90% over the past year and 1 month, 25% on the 10th of October. And just based off their financial statements, I don't see any sign of this company turning things around unless management get together and say, we need to do a strategic review of what we're spending on our costs we have in this business right now, because we have no scale. Revenue is not increasing at a quicker rate than we need to cover the increase in costs. So at this point in time, I will be following Daba and this story because it has become more interesting to me just based off their financial statements. I haven't had a look at Daba for probably 6 to 9 months because the share price has been falling. This company has always been burning through a lot of cash, but it has gotten worse over the past year. So if you like to leave any thoughts in regards to Daba, any opinion, if you think I'm completely wrong and you don't mind this company burning through so much cash, if you don't mind this company spending over $2 million on travel costs, leave your opinions, your thoughts in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.